Okay, so let's continue with the remaining portion that was incomplete when the stream ended. So we were doing this question. Let's quickly solve it. And we are calculating the TTP. So we will first calculate the adjusted trading profits. But here when you're drawing the pro forma, please draw it in the way that is, needed. So we need to calculate TTP. So therefore I will write here trading income. Okay, and here in the working notes, we will calculate adjusted trading profits. So here I will do first calculation of trading income, and let's do all the adjustments here. Okay, now let's take one by one. So I have revenue, cost of sales, gross profit, other operating income, and all these details are given to us. So we'll start with profit before income tax and make all the changes there. So whatever is disallowed, we will add it, and whatever is allowed will be as it is. So here I will write profit before interest, profit before income tax. It is 150. Although actually the starting point should be operating profit, because we can see here, see interest from investments, income from investments, interest expenses on loan. Nothing needs to be come here. Only interest and expenses may come here. Let's see the notes. So I think yes, the starting point always in our exam is also operating profit only. So let's start from there, which is 128. Now let's take one by one. So we are having revenue, cost of sales, no adjustment. There is another operating income of 26. And so let's do the question now. Now here we have 128 as the starting point. Now other operating income includes 26,000 on the profit on disposal of a shop building, which is not a part of your trading income. So we'll reduce it. Index gain on disposal is 15,000. Doesn't matter. We will reduce the gain, which is the chargeable, which is the operating, which is included in the operating income, which is 26,000. So here I will reduce profit on disposal of a shop building, which is 26. So that I will reduce from here because figures are in thousands. Okay, now let's go to the next one. Yeah. So now we have selling expenses. The other details is for general and administration expenses. So let's go for that working. So here we have general and administrative expenses. It says it includes wages and salary, which is allowed as an expense. Light and heat allowed, accountancy fees allowed, sundry expenses allowed. But then the further reading tells us sundry expenses include client entertaining, which is disallowed. So that I will add back. Staff entertaining is allowed. Qualifying charitable donation I will add back from here because I will reduce it later from the total profits. And 27,000 allowable expenditure. So we need to add back 62,000, right? So we will add back client entertaining, and I will add back qualifying charitable donation, which is 3,000 here, and this, oh sorry, which is 3 because figures are in thousand, and this is 62. Okay, now let's go further. We have a depreciation expense. It is a non-cash expense. It is not allowed as per income tax. So we will add back depreciation always, which is 38. Now let's go to the next one. We have income from investments. It will not come here. And let's see what is given here. Interest. Income from investment is rental income in respect of an office building. Of course, it will not be coming here. Interest income includes bank interest receivable, loan interest receivable. Again, it will not be part of the income here. And yeah, then we have interest payable of 20,000 in respect of company's loan notes which were issued in order to finance company's trading activities. So it is a loan note issued to finance the company's trading activities. So therefore it is the loan interest relating to the business purposes, right? So I will reduce here interest on loan, which is 20,000, right? It is 20,000. Now we have any other pointers? Let's see anything else. So we have taken this, we have taken note 1, note 2, note 3, note 4, note 5, and note 6 is capital allowances of 32,000. That will reduce your profits, right? So here you will reduce capital allowances of 32,000. Less capital allowances and you will reduce 32,000. I hope very clear. Now let's take the sum, and that is your trading income. So that becomes 153. Now here I will take 153. Okay, the next one is, now you will take the remaining income. So you have income from investments that is to be taken here, and interest income. So both we will be taking it here. So I will take here income from investments, because these are other income, right? And interest income. So income from investment is 19 that I will take here. Interest income is 23 that I will take here. So I've taken here interest income, trading income, and interest from investments. Any other thing to be taken here? Let's see. We have to reduce QCD that I remember. Let me see any other working which I have not taken. So interest payable here I have taken, this I have taken. Here I have taken everything. Yeah, indexed gain on disposal. So chargeable gains we have to take, and you know indexed gain will be the gain that will be coming for chargeable gains. So here chargeable gain I will take, and I will add 15. To know more about the index gain, guys, I will tell you that when we go to the next chapter. And we will reduce QCD. QCD is 3. You reduce it, and now you get your TTP. Your TTP is 207. Total taxable profit. Now let's calculate the corporation tax on it, so that we understand that portion as well. Now this is 207,000 TTP. There is no dividend which is given here, so the same is augmented profit. The augmented profit is 207,000. So it is not covered by the lower limit, it is not covered by the upper limit, it is in between. So let's apply marginal relief method, and I will tell you by both the methods of marginal relief and marginal tax method. If I apply marginal relief method, what will be the corporation tax liability? So corporation tax will be step 1, calculate the tax at main rate. So on the TTP you will apply 25%. So that will be this multiplied by 25%. Now you will reduce marginal relief. How do you calculate marginal relief? Please look at my screen. We will take the upper limit threshold, which is 250,000. From this we reduce augmented profits. Now here we don't have augmented profits, which is different than TTP, so I'll take the same profits, 207,000, multiplied by fixed index of 3 by 200, fixed figure. Then ideally we multiply it with TTP divided by augmented profit. Here TTP and augmented profits are same, so nothing to multiply, it will be same. Now reduce this figure as marginal relief. Okay, let me remove the zeros, because I've already taken the zeros, right? I've already removed them. So let me remove the zeros from here. So it becomes negative 0.645. Now you reduce it, and you get a corporation tax liability of 51.105 in thousands. Let's calculate the same by another method also, which is marginal tax method. Understand that marginal tax method only gets applied when there is no dividend. In this case here there is no dividend income, so we can apply marginal tax method. That says step 1, calculate at the lower limit the tax. So lower limit is 50,000, calculate tax on 15,000 at the rate 19%. So that will be 50 multiplied by 19%. I get 9.5. With this you will add marginal tax. Now what is marginal tax? On the remaining amount of TTP, multiply 26.5%. So the remaining TTP is 207 less 50. Because 50,000 we have already taxed, multiplied by marginal tax percentage, which is 26.5%. So you will take here 207 less 9.5, less 50 multiplied by 26.5%. When you take it, you get 41.605. Add it, and you get here 51.105. So both options will give you same answer if there are no dividends. Clear? Absolutely. Let's go to the next topic revision now. So now we are going to revise quickly the chargeable gains. Yes. So now moving ahead with the chargeable gains, guys. Focus on my screen quickly. Everything else remains same, just like individuals. Only a basic difference is there. So only two differences are there when we calculate chargeable gains in case of corporations. Number one, no AA is allowed to corporations. In place of it, we get indexation allowance. So when you reduce cost, on the cost or on the capital improvements, you will calculate indexation allowance. That's just like taking an effect of inflation. What you will do is indexation factor is going to be given to you. Just multiply on the cost and get the indexation done. And just understand that you will do the indexation allowance only till December 17 and not beyond it. If your cost is 1 lakh, factor is given as 0.207, and that factor will be given to you in the exam. No need to be troubled for it. Multiply 0.207 with 1 lakh, that is 100,000, and then that would be an additional reduction that you will do along with the cost. So in place of AEA, you will get indexation allowance. So just understand that whenever we will calculate gain, we will always reduce the indexed cost. Index cost is cost plus indexation allowance. Clear? That's one point of difference. Second point of difference is when we do the shares and securities and the three-step matching process, that matching rules that we do. First rule is same for corporations, that match the shares sold against the shares purchased on the same date of disposal. Then rule number 2 is changed, that says match the shares sold against the shares acquired. Against the shares acquired, again, shares acquired within 9 days prior to the date of disposal. So within 9 days prior to the date of disposal, and that too on a FIFO basis. So there also we applied FIFO, here also FIFO. Just that in individuals we take next 30 days, here we'll take the prior 9 days. Clear? Third step is now match the shares sold against the shares purchased before 9 days, and you make them together as a shares pool. In corporations, we call it as FA 1985 shares pool. The only another important point which is very important is that when you will calculate that proportionate cost in step 3 on shares pool, you will always calculate proportion for the indexed cost and not the regular cost. That means here you will prepare 3 columns. One column will be for number, then we will have cost, and then we will have indexed cost. Now just look here. Let's see, you made the purchase on 1st April 2000 and the purchase was for 1000 shares. Cost was 10,000. You will write it like this. Now till the next purchase, that is known as the next operative event, you will add indexation allowance. So I will take indexation allowance, and let's say the indexation allowance is 0.207. In the index cost, I will take 10,000 and I will multiply it with 0.207. Then get the totals. You will get the totals here. Now again, the next operative event is the next purchase. Let's say the next purchase is made on 1st August 2004, and that is of 2000 shares. You will add the cost 15,000, the cost. For example, again we will take indexation allowance. Let's say we are just taking it till December 17 and the factor is 0.408. So you will multiply on the indexed cost. Okay, but you will not multiply on this cost. You will again get the total, and then on total you will apply the indexation allowance. So get the total, because we always apply it on the cumulative cost. Now here you will do indexation allowance and you will just multiply this with the factor 0.408, and accordingly now you will do the calculations. Got it? So I hope now you're clear how to do the indexation allowance. Bonus treatment, right issue, everything is same just like we do for individuals. There is no change. Only one additional point, in case of corporations, there is no relief that is applicable to corporations except for rollover relief. And in rollover relief, there is one change. In individuals, when we studied, The qualifying assets were fixed plant and machinery, land and building, and goodwill. Here, the qualifying assets are only fixed plant and machinery and building, land and building. No goodwill is a qualifying asset here. The asset should be acquired within 1 year before or 3 years after the date of disposal. And when we roll over or when we do a deferment of the gain, we will always do a deferment of indexed gain and not the unindexed gain. That's all. You're done with chargeable gains revision. Simple and easy. Let's do the next one. The next one is losses for the companies. Now, please understand, in case of losses for the companies, when we do the losses adjustment, again here also we have a current year relief, carry back relief, and carry forward relief. The difference is that number one, when we want to go for a carry back relief, that is making the relief of the losses against the previous 12 months prior to the current cap, then we need to do a current year relief first. First, make your total profit zero, and only then you can do a carry back relief. Got it? Now, if you want to do a carry forward relief, there is no problem because we can do a carry forward of the loss partially also. But current year and carry back will be done in full. If the QCD is lapsed, that's okay. Because when we do group relief, you will understand that these lapsed QCDs or the QCDs which are unused, they can be surrendered under the group relief to another company within the same group. So there is no problem here. Okay. Now, which are the losses that can be surrendered? Property loss will be surrendered, and only when it is fully adjusted with the total profits, only then the excess property loss can be surrendered under group relief. Okay, and the remaining loss can be carried forwarded to the next year cap also. So property losses can be used for losses relief. Trading losses can be adjusted, of course. The trading loss will be adjusted. Current year trading loss will be adjusted in full, and any brought forward trading loss can be adjusted partially also. Then capital losses will be adjusted within their own head, that is chargeable gains only, and that's all. Okay, so again, I hope now you're clear with the current year relief and the carry back relief for the preceding 12 months and the carry forward relief. Few other pointers that I have to cover here is yes, terminal loss relief. Now, in case when there's a terminal loss relief, we will have the losses that have occurred in the first 12 months, in the last 12 months prior to the date of cessation of business, last 12 months. And that we will adjust against the trading income only. Okay, only against the trading income, and that will be adjusted against yeah. No, here we will adjust it against the total profits only. Just yeah, so it will be adjusted against total profits only. In individuals, we had the trading income concept. So now you will carry back the losses, the trading losses against the preceding 36 months on a LIFO basis to be adjusted against the total profits. Done. So we are done with terminal loss relief also, and property business loss, capital loss, everything we have covered. So simple and easy is your corporation losses. Let's take up the last topic of corporation losses, and we just are left with then VAT. So under the corporation tax loss, corporation taxes, the topic group is highly important here. Okay, now what are the testing points here? The testing point is that what is a group and how do you set off the losses here. So here we'll study two types of groups. One is a group where the normal trading losses, property losses, QCDs can be adjusted. Second, we will study about the chargeable gains group. The chargeable gains group is a group within the companies which are there in this group. They would be able to, transfer the non-current assets within among each other, among those group companies, okay, at no profit, no loss. So there will be no chargeable gain that will be calculated at that point. So that is how we understand about the CG group. I'll take it one by one. First, I will take the normal group, which is a 75% group. And why this group is there? So that the current year trading loss can be surrendered, brought forward trading loss can be surrendered, your property business loss can be surrendered, QCDs can be surrendered. Surrendering means that one company can share these losses and transfer these losses to another company so that overall as a group the overall profits and the taxability gets reduced. Now, number one, when it comes to current year trading profit, current year trading loss, it can be surrendered in full, which means the company which is surrendering the loss can even surrender the full current year trading loss even without adjusting it with its own current year total profits. It can surrender it in full. So, excuse me. Current year trading loss can be adjusted in full to the claimant company. The company which is surrendering the loss, we call it as a surrendering company, and the company which will receive the loss, we call it as claimant company. Done. Now comes the next point. Ma'am, what about the property business loss? See, current year property business loss will only be surrendered first after adjusting it with the surrendering company's own total profits. Only when it has been adjusted with surrendering company's own total profits and the remaining property business loss, that is the excess property business loss, can be surrendered to the claimant company. Likewise, QCDs also we will first adjust with the surrendering company's total profits and then only the excess QCDs can be surrendered to the surrendering company. Only current year trading loss can be surrendered in full. Rest all the losses, be it property business loss, be it QCDs or the brought forward trading loss, they can only be adjusted in excess. First, they have to be adjusted with the surrendering company's profits, total profits, make them zero, and then only the remaining losses can be adjusted with the or can be surrendered to the claimant company. Clear? Okay. When we see the 75% group, then it is very important to establish a direct and indirect relationship. In the example where I told you about the associated companies, we established a direct and indirect relationship. Clear? So here also, the direct relationship between a parent and a subsidiary has to be minimum 75%, and indirect relationship between the parent, the ultimate parent, and the subsidiary also has to be minimum 75%. Very important. So A to B 75%, A to D and E, like in this example, also needs to be minimum 75%. So if you see here I calculated the effective interest. So this entity E, A's effective interest is only 67.5%, which is not minimum 75%, and hence since it is not minimum 75%, it will not be part of the 75% group relief, and no losses in this 75% group of A can be surrendered to E or can be claimed from E. I mean, nothing can be done with E. Done? Clear? So now we have done the rules also. Few more rules that I am covering up. Number one, both the entities, the surrendering company and claimant company, should have the same accounting period ends, and the cap should have the same cap period. If that is not seen, that we know that we call as non-coterminous, then we need to make them. Then we only can then the surrendering company will only surrender the losses, and the claimant company will only claim the losses to be adjusted against its own total profits for the common period. Okay, now what does that mean? So let's take an example here. Let's say the surrendering company's accounting period is from 1st April 20 to 31st March 21. Okay, now, and the claimant company's period is from July 20 to June 21. What is the common period here? Common period is from July 20 to March 21. So please calculate proportionate loss and proportionate profit for this period only, and the losses that can be surrendered would be lower of the two. Like here, the surrendering company's 9 months losses are 112,500, and the claimant company's 9-month profits are 225,000. So maximum losses that can be surrendered would be lower of the two, which is 112,500. Clear? Great. Let's take some more examples like this. So when second case is when a subsidiary company joins the group in the year. So of course you will take the common period from the date of joining till the common period ends. Clear? So you will not take from the start of the accounting period. You will take the period when the entity joins the group. Likewise, when an entity is or subsidiary is leaving the group, then for you the date of leaving, the date of making the arrangements of sale, this is the term that we use. When the arrangements of sale have been done, that is very important rather than date of actual sale. That you will not take. So you will take the common period from the start of cap till the date of arrangements of sale. Clear? Now comes the next point, ma'am. What is the profit against which the claimant company will again adjust the loss? How do we calculate that profit for claimant company? Please understand, when you calculate the profit against which the claimant company will adjust the loss is its own total profits less all losses that it has. Whether when the claimant company has its own current year loss, claimant company's own brought forward loss, both you will adjust. So first claimant company will adjust all its own losses, then arrive at TTP and even adjust its own QCD, then arrive at TTP, and against that TTP then we will do the surrendering of losses. So surrendering of losses will be last point. Group relief is last. First do your current year, carry back, carry forward, all that relief. Done? Okay. Now I come to the next portion, which is understanding about the chargeable gains group. This is also known as 75% chargeable gains group, but the beauty here is that we only need direct relationship between the parent and subsidiary to be 75%. But the indirect relationship, that effective interest between the ultimate parent company and the subsidiary needs to be only minimum 50%. Yes, that doesn't need to be 75%. Remember it. Correct? So accordingly, the 75% chargeable gains group is created. The few rules that we need to understand here is number one, when the assets, chargeable assets are transferred between the two companies in the CG group, they are done at no gain, no loss. And in future, when that company that has received the asset will sell off the asset, then it will use the cost as the cost to the original company. Let's say A transferred a chargeable asset to B, B sold it to a third party. So B will reduce cost. What was the cost to A? Okay, the original cost to A. Next, it is not just necessary that we transfer the asset, even we can transfer the losses. Yes, losses can also be transferred from one company to another rather than a transfer of asset. So that can also be done. And we will always calculate the indexation allowance. So understand here, this is important. How do you calculate the indexation allowance in these CG group cases? First, you will calculate indexation allowance from the date of acquisition till the date of transfer. That point you will have indexation allowance, and that will be calculated for base cost. Remember, so base cost will be original cost to A plus indexation allowance till the date of transfer. When the asset is subsequently sold, then you will again calculate on this base cost. On this base cost, you will apply indexation allowance, and that you will calculate till December 17. So indexation allowance working is very important here, which I'm sure now you have got hold of it. Got it? Okay. Let's take a small example to understand this, and then we take up VAT. So Lay Limited owns 100% of ordinary share capital of Mon Limited. The results of each company for the year ended 31st March 25 are. So what are the results? The Lay and Mon, the results are given to you. On the loan, interest receivable is in respect of loan which is for non-trade purposes. Okay, this is for non-trade purposes. Now, what is the maximum claim that can be made by Mon company? The maximum claim will be, first we will take its own TTP after adjusting everything. So how do we calculate it? 60,900 is the property business income plus 3,300 loan interest receivable less trading loss of 11,200 and less we will do a QCD of 3,200. So Mon company is having the TTP of 49,800. So Mon company can do a maximum group relief adjustment till 49,800 only. What is the maximum loss that Lay company can surrender? Let's take Now first, see, trading loss current year can be adjusted in full. That's not a problem. So we can adjust it in full. For the property business loss, we have to first adjust it with the whatever is the total profit, make it zero, then only remaining loss can be surrendered. So we do have a loan interest receivable of 1600. So property loss that can be surrendered would be 26,700. So this is the current year trading loss. This is the property business. Okay, so you have here 26,700. Now from this you will reduce 1300, 1600, which is the interest receivable. So now your TTP is zero. For surrendering company, entire losses are adjusted. So the remaining excess loss that we have, now this can be surrendered to the claimant company. Next, we have capital loss that is not surrendered because it is a loss that can only be adjusted in-house. It is not allowed available for surrendering. So that we will not surrender. QCD we will surrender because now the total profits are zero. So QCDs are lapsing. Instead of lapsing, we can surrender into the claimant company 4,800. Now the total will be, so total we get here is 48,600. What is the maximum loss that can be surrendered? Lower of the two. Lower of the two is 48,600. So we will surrender 48,600. Right? So I hope I'm very clear here. Okay, let's move forward. Okay. Oh, I've written your trading loss wrong. It is 18,100. Yeah, so the maximum loss that can be surrendered is 48,000 or 49,800, which is lower. So it is 48,000. Done. Clear. We're done with corporations completely. We have done all the topics for the revision. Now we're just at the last topic, which is VAT. So quickly, let's understand VAT here. Now quickly, what is VAT about? VAT is basically the only indirect tax which is there in the syllabus, and VAT simply reflects that what is the tax effect as a result of the value addition that is made at each of the different levels when the goods get passed on from one stage to another to the final consumer. Here important pointers to note is when you take the value excluding VAT. Now stop here. In order to understand the concept of including and excluding, it's very important for VAT purposes. So first, I will make you understand this performer, and then we will understand the inclusive and exclusive concept as well. Now understand there are four persons in this supply chain: manufacturer, distributor, wholesaler, retailer. In this example, now we are considering VAT. VAT is the introduction of tax on the supply of goods and services. Clear? So let's say the manufacturer purchases these goods at 100 cost excluding VAT, and VAT I will take separately. Now on this he adds his margin, and we get the value of supply. The term is value of supply, which is just simply the value on which VAT is to be charged. Then we apply VAT on it, which is a standard rate of 20%. We get the consideration of supply. Again, this is also excluding VAT. This is the consideration that has to be received from the other customer. However, customer will pay the value including VAT. Yeah, so sorry, this is also including VAT. So customer will pay me the amount 132, but is this the cost to the customer? No, because VAT is never a cost unless VAT is not going to be repaid by the government. But when you collect when you collect output VAT on the goods that you sold to the customer, then the input VAT that you pay at the time of purchasing the goods, so that will get adjusted, only the net amount you pay to the government. For example, here the input VAT for manufacturer is 20, output VAT is 22, so net only 2 he will deposit to the government. And for the next person, distributor, the cost to him is not 132, but the cost is 100. The cost is 100 for him. Done? Clear? Now, very important that what is VAT charged on? VAT is always charged on the taxable supplies. And what is a taxable supply? It is a total of standard rated supplies and zero rated supplies. When you combine the two, you get taxable supplies. Always, always remember wherever the term taxable supply is used. There is another supply which is exempt supply, which is not a taxable supply because you don't pay any taxes on it, and no input VAT on exempt supply will be allowed as a credit. However, when it is a zero rated sales, although you're not paying taxes here also at the time of making a sale like exports, but then the input VAT that the trader has paid would be allowed to him as an input VAT credit that can adjust against his output VAT. If that is not there, then he can claim a refund for the same. Now let's quickly understand the concept of inclusive and exclusive VAT. Please take the value of supply as 100, VAT is 20, and consideration of supply is 120. If the question tells you that this value is including VAT, that means it is proportionate. I mean, it is value which is all equivalent to 120. So if your selling price including VAT is 200, if you have to calculate VAT, simply divide 200 by 120 and multiply 20. So this is the proportion that you will create in your exam also and do the calculations. If the value is excluding VAT, then the life is easy because on the value excluding VAT, you multiply VAT. So we will multiply 20% on it and get the VAT amount. Done? Clear? Great. Now, who is liable to claim input VAT credit? Who is liable to pay output VAT? That means deposit output VAT to the government. The output VAT that is collecting on the invoices that that is being that is he's collecting from the customers. So he should, how he gets that right? He will only get the right once he's registered with the tax authorities. So what is the criteria for a taxpayer to be a registered person here? In order to claim input VAT credit, pass on VAT, charge output VAT on the invoices, collect them from the customer, deposit it to HMRC, file VAT returns. For all this, he needs to be registered with VAT. So what are the criteria for VAT registration? Number one, a person is required to be mandatorily registered for VAT if he satisfies number one, historical test, which is a by default test, or if he satisfies the future test. What is historical test? Historical test is historical test is at every month end or at the month end. Please see the last 12 months turnover. At a particular month end, please take the last 12 months taxable turnover. If that taxable turnover is exceeding 90,000 at that month end, then the taxpayer needs to be registered. For that, he needs to do two things. Number one, notify HMRC of this exceeding of 90,000, and that has to be done within 30 days from the end of the month. Number two, the effective date of registration. Now, the effective date of registration is first day of the second month. First day of the second month, it is going to be the effective date of registration. For the taxpayer, that means his invoicing and everything should start from the second month, first day. From that day, he has to start doing the invoicing properly on the VAT invoice. Let's assume that the month end when this turnover limit got crossed is 31st October. So second month is November, December. By 1st of December, he would be eligible that he has to issue VAT invoices, and he would notify HMRC within 30 days. 31st October, 30 days will be 30th November. So by 30th November, he needs to inform HMRC of the same. Okay, notify HMRC of the same. Now, can he go for a voluntary registration also? Yes, he can. Because of course, to pass on VAT, to claim input VAT credit, he can go for voluntary registration also. Can there be a deregistration? Yes, there can be. If the taxpayer can satisfy HMRC that in the coming 12 months his taxable supplies would be less than 80,000. If in the coming 12 months his taxable supplies would be less than 88,000, then the HMRC may just waive off the requirement. Clear? Now just an elaborate definition of taxable supplies, which is equal to standard rated supplies, zero rated supplies. Plus it also includes if there is a non-zero rated interest in land which has got a lease of up to 21 years only, then that is also included. Now one more test, we just did the historical test. Another test is future test. If historical test doesn't get satisfied, then we will also go for future test. Otherwise also we can see the future test. We just have to see by which method the criteria is met. Future test says if in the next 30 days the taxpayer is taxpayer what do you call are expected, the taxable supplies of the taxpayer are expected to be crossing 90,000 in the next 30 days, then it says that the future test is met. Now, when the future test is met, date of notification to HMRC is same within 30 days from the date itself. That let's say the future test is met on 1st of December, then 30 days will end on 31st December. So by 31st December, notification to HMRC must be made. Second is what is the effective date of registration? The effective date of registration is the day itself, that is 1st of December only. So from the day itself only the taxpayer needs is registered. That is from today only. 1st December only he has to issue VAT invoices. Okay. Now very important, can we reclaim the input VAT on the goods that we are holding on the day we got registered? Yes, provided that that stock of goods that you have, which is the opening stock on the date of registration, you take the goods that were purchased in the last 4 years only prior to the date of registration. So those goods input VAT credit can be reclaimed. Okay, input VAT paid on it can be reclaimed. Second, if the services have been taken in the last 6 months prior to the date of registration, then input VAT on those services taken in the last 6 months can be reclaimed. That's all. And if there is any VAT on the goods that is sold, then that is not going to be reclaimed. Only the stock goods we check. Okay, only the goods which are in stock we check. Now, can we recover input VAT credit on all the goods? Typically, yes, but there are some exceptions on which you cannot recover input VAT credit. Number one is motor cars. By default, when you purchase motor cars, there is no input VAT credit you can claim on it. But you can reclaim on it. But if the taxpayer is in a typical motor running business only, like Uber, Ola, Zoom cars and all, car driving school, then in that case, VAT can be reclaimed on it. However, if there is any personal use, then by default 50% is going to be disallowed for personal use on VAT credit. Clear? Second, that is only for the motor cars. Only for the motor cars for which we have claimed VAT credit like Zoom and all. If there is any personal use, then by default 50% will be disallowed directly. Okay, now next. Irrecoverable VAT credit is also there when there is business entertaining done for the UK clients. So for the UK clients, if there is any gift, any entertainment done, it is disallowed. But for overseas client, when we do any kind of entertaining, it is allowed. That means input VAT credit can be availed on the entertainment done for the overseas clients. For employees, when you give gift, when you do the entertaining, it is all allowed. Only for the entertainment of customers in UK, it is not allowed. Now comes very important point of tax points. Now, what is basic tax point? Let's quickly just understand. It's the normal tax point. I mean, normally what would you do? How would you tax your goods? How would you tax your services under VAT? So goods should be subject to VAT when the goods are delivered to the customer or dispatched or received by the customers, correct? Services should be put to tax when they are rendered by the provider to the receiver. Done. But there are exceptional cases. There are only 2 exceptional cases when this normal rule will not hold true. When number one, either invoicing or any payments have been received before this rendering of service or delivering of goods, then the earliest date you will take and that will become your tax point. Clear? Then after the delivery of the services, or after the delivery of the goods or rendering of services, let's say within 14 days the invoice is issued, so then that invoice issue date will become the relevant tax point. That's all. These two exceptions only you need to understand. So one is the basic tax point, the other one is when invoicing or payment takes place before it, then you take the earliest date. If invoicing takes after BTP but it is taking place within 14 days of the basic tax point, then that becomes a relevant point. Clear? Easy? Okay, let's go to the next one. In case of impairment loss relief claims, 3 pointers to note. Impairment loss means what? Bad debts. Bad debts are written off in your books of accounts. So 3 important points to note. Number one, the impairment loss must have been written off in the books of accounts. Number two, the debt is overdue by 6 months. So you go to the due date of debt and from there you see 6 months more. That means debt is overdue by 6 months. Only when it is overdue by more than 6 months, only then impairment losses can be written off and the output VAT will be reversed. So you will get input VAT credit on that impairment loss. Got it? And yes, so these are the two conditions that are important to be noted. And of course, at the time of initial transaction, VAT was collected and deposited to HMRC. Done? Clear? Yes. Now, in case if subsequently the impairment loss is no longer there because bad debts are recovered, then again you will charge output VAT and deposit it to HMRC. Next is the motoring expense. If there's any repairs and maintenance done, whether you use a particular car for your own purpose or business purpose, any reason, VAT credit will be allowed on the same. Clear? Now, the question point is here when a business pays for the private fuel. Let's say you have taken a car for, the employer has given you car for use. And along with that, he is also reimbursing for the fuel. Not just for the business purpose but for private purpose also, and the business now wants to claim complete ITC on it, on the private fuel as well as business fuel. Now we know that ITC can be claimed on the business fuel, there is no problem, but on private fuel if the business wants to claim ITC, then they need to show a output VAT also on the same. So in one place they will take input VAT of 100 on that personal use and output VAT of 100 also they will show. So net effect will be there. When would they do this? When it's not possible to segregate the input VAT in private personal journey and business journey, then of course they will adopt this approach. So what are the various options available in this case where there is both input or VAT on business journey and private journey? Number one, like what I suggested, take the full input VAT and show output VAT on private journey. Number two, don't take any input VAT credit. Leave aside business and personal, leave the entire input VAT. Or third, if you can segregate, then take the input VAT credit only on business purchase, only on the business miles travel or business fuel. Clear? Done? That's the only thing that you need to do. So I'll just take one more important point and then we'll discuss about the penalties. Okay, that's the change point and we'll do a question also on the same. Now, when it comes to VAT, there is a concept of substantial traders that simply says it's a kind of an administration portion of the VAT. Okay, so substantial traders means that if there is a trader who has got the VAT liability in the previous 12 months, which is exceeding 2.3 million in the previous 12 months, then what they need to do is they need to deposit VAT. The due date is one by whatever is the VAT period, okay, which is going to be given to you. So VAT period end, you take 1 month and 7 days and deposit the VAT. But for substantial traders, they will only get 1 month after the VAT period end to deposit VAT. Number two, they need to make 2 POAs also. 2 POAs in the quarter only. See, VAT is always paid quarterly. So we have typical VAT periods ending in January, then April and so on. But of course, you will see as per the question also. Now, in a quarter, the second and third month, the last substantial trader needs to make POA. And what is the amount of POA? 1/24 of the last 12 months VAT liability. that will be paid by way of POA in the second and the third month of the quarter. And then any amount remaining which is as per the actual VAT liability to be paid, that will be paid along with the VAT return filing within 1 month from the end of the VAT period. This is the only thing that you need to know. Now, next is penalties. I'm taking penalties with a reason, because penalties are the changed portion. I mean, they are frequently tested topic in exam for VAT. Now understand, we can have penalties in two cases, right? One is when VAT return is filed late, or number two, when VAT is paid late. If you file VAT return late, if you file the return late, then up to first 3 returns that you file late, you don't have to pay any penalty. The moment you have the fourth VAT return file late, now you will have 4 penalty points. Every return file late gives you 1 penalty point. And we always check it in a span of 2 years. Okay? In a block of 2 years, we will see whether what are the delays that have taken place. So in a block of 2 years, up to 3 penalty points, it is no problem. When the moment you have 4th penalty point for filing your VAT return late, you will have a penalty to be paid flat 200. Flat 200 is the penalty that will apply. Yes, no percentage, nothing, flat 200. And after this, every subsequent return that you file late, again flat 200 is the penalty. Yes, this will go on till you have a complete 12 months period, that is known as the period of compliance, where there is no delay in filing the return. If you have that complete 12 months period, again your points will be reset to 0. Done, clear. That's all for late filing of return. The moment you late pay taxes, first is from the day that you paid late, from the day your due date is crossed. That is normal cases 1 month and 7 days from the end of the VAT period. The next day only your VAT interest will apply, 7.75%. That will be given to you in the exam also, and you will calculate for every day the delay is there, the interest will apply. Next, there are two types of penalties which are there. One is a daily penalty, another is a fixed penalty. The table which is going to be there will be given to you in the exam, don't worry. Let me show you the table also here, how the table will look like. Yes. Okay, so this is the table and it will be given to you here. So what is the penalty? Up to 15 days, there is no penalty. If the delay goes beyond 15 days to 30 days, then you'll have a fixed penalty of 2% on the VAT amount which is unpaid. 2% on VAT amount which is unpaid. Now, if the delay is beyond 30 days, then you'll have a 2% fixed, 4% fixed penalty on the amount which is unpaid, plus 4% daily penalty. So the daily penalty you will take for the days in excess of 30 days. Let's say the delay is 40 days, then you will calculate daily penalty only for 10 days. And multiply with 4%, 10 by 365 you will do. Done? Okay. Now, so we are clear with the VAT. We'll do a question also to understand this. Now last, I'm taking one more point, which is VAT schemes. Okay, no, one more point I have to take here, then I'll take a VAT schemes. Now when I know the person is registered, the registration is going to be done for the dealer, the registered person is going to be there. So then he needs to issue VAT invoices, correct? Now, when we do VAT invoicing, few pointers are very important to note. Number one, detailed VAT invoices will be needed in the normal cases when the goods are to be sold or transferred from one registered person to another registered person. That will only be done by way of VAT invoices. Detailed VAT invoice would mean that it will have all the details like name and address of the seller, the tax point, the value of the gift, the date of transfer, name, address, VAT registration number for the customer, for the seller, the detailed description of the goods, tax amount on it, VAT amount. So all that will be there. Okay, and please, that understanding of these pointers are very important. No need to learn them, but understand what is a detailed VAT invoices will include. Second is less detailed VAT invoices are needed if the VAT inclusive amount is up to £250 only. Then you don't need to include these detailed VAT invoices. You just need to do a normal VAT invoicing. And remember, in that case, of course, zero rated and exempt supplies will not need to be invoiced for VAT. But when we do detailed VAT invoices, the zero rated supplies are also invoiced on VAT invoices. Now next is, if the VAT inclusive amount is only up to pound 25. That is for petty expenses. There's no need for VAT invoice. Even on a normal invoice, VAT input can be claimed. Okay. Yeah. Next, in case of imports, we follow postponed VAT accounting. So in case of imports, we will have postponed VAT accounting. What is postponed VAT accounting? It simply means while we import the goods on the port and we pay custom duty, no need to pay import duty on the VAT. That is a VAT amount on it, because the person who sold is not there in the country, right? He's not subject to UK taxes. So therefore, in order to claim input VAT, when you earn the payment, we need to show output VAT also. Okay, that means what? Here we'll follow postponed VAT accounting. It simply means that in the next VAT return, which is applicable to the taxpayer, in the next VAT return, he will show input VAT on these goods and the same amount he will show as output VAT. Yes, there will be no gain, no loss, and nothing will be burdened on the taxpayer. Just that the VAT can be passed on then. So in order to pass on the VAT, we need to show input VAT and output VAT both in the next VAT return. Clear? For exports, they are zero rated transfers. Exports are always zero rated. We can claim input VAT credit on the same, but no tax will be applicable in case of exports. Done. Last pointer here that I have to cover is the VAT schemes. Very frequently tested. There are some special schemes that are available to the very, very small traders, basically to ease their VAT burden. So administration, calculation, all that. First is a cash accounting scheme. Cash accounting scheme is a very interesting scheme that simply says that instead of doing the calculation on accrual basis for the purchase and sales and calculate VAT on it, for the very small traders, very small means what? Those traders that have an expected turnover of not more than 1,350,000 in the next 12 months. In the next 12 months, it is not expected to exceed 1,350,000. And in the previous 12 months, they've never had VAT defaults, penalties, nothing applicable. Then in that case, yes, they can join the scheme, and now they will just have sales recorded on a cash basis, purchases recorded on a cash basis. So actual output VAT, actual input VAT is there, net off, and the VAT is going to be deposited. So very, very good scheme. The taxpayer needs to leave the scheme the moment, when the turnover exceeds 1,600,000. So 1.6 million in the next 12 months when the turnover exceeds, of the previous 12 months. When we'll see the previous 12 months turnover, if it exceeds some 1.6 million, then the trader has to leave the scheme. Okay, so very good scheme. Next scheme is annual accounting. As the name says, that instead of doing the quarterly return filing, the taxpayer can do only one return to be filed within 2 months from the end of the accounting period, from the end of the tax year. No, year end only will take. From the year end, will take 2 months, and within that 2 months period, the return must be filed. But I never said about the taxes. I never said about the payments. Why? Because when you want to file only one return for a year, you need to make 9 equal payment on account. So 9 payments of taxes will be made in the tax year, in the account, in the year, and these 9 payments will start from the 4th month of the tax of the year. So from your accounting year, please take the 4th month. Let's say my regular accounting period is January to December, then I will start with April. So April, May, June, July, August, September, October, November, December. For these 9 months, we will make 9 equal payments. How will you determine the payment? You will take last year's total VAT liability, and that total VAT liability multiply 90% to it. So what you will take? You will take the last year. Let's say the last year ended on 31st December 23. Sorry, take the last year's take the last year's total VAT liability. Now take 90% of it. Okay, total VAT liability, and multiply 90% to it. Now when you multiply 90% to this VAT liability, whatever is, Yeah, you take 90% of it. Now, whatever is the amount, let's say the amount was 100,000, multiply 90%, and we get here 90,000, correct? Now divide it into 9 equal installments, 10,000 each. So that 10,000 VAT amount will be paid from the fourth month from the start of the year. Fourth, fifth, sixth, seventh, eighth, ninth, 10th, 11th, 12th. Done. Any remaining amount to be paid will be made along with the VAT return that we will file within 2 months from the year end. And again, the trader will leave the scheme the moment the turnover exceeds 1.6 million. The same like cash accounting scheme. Now, last is the flat rate scheme, which is very popular for your exams, where we see what is the VAT exclusive turnover. So now the VAT turnover which is excluding the turnover excluding VAT should not exceed, is not expected to exceed 150,000. So they are very, very small traders. Okay, in the next 12 months, the VAT exclusive turnover is not expected to exceed 150,000. Only then that trader can join the scheme. So the implication is that now you calculate VAT inclusive turnover. So you took VAT exclusive turnover to see 150,000 limit. Now you will take VAT inclusive turnover to calculate VAT. And that VAT will be VAT inclusive turnover multiplied by flat rate given to you in the exam. Okay, no VAT input credit, nothing will be taken, only the VAT inclusive turnover multiplied by the flat rate percentage. Done. Next, very important, if it is the first year that the person has enrolled for the flat rate scheme, so then 1% will be allowed as reduction in the first year. Done. Done with all schemes. Let's do a question and finish off with our revision. So let's do a very interesting question here. So there are two questions that I have taken. Quickly I'll take it to make you understand completely the concept of VAT. Yes, so the question says Gwen is in the process of completing a VAT return for the quarter ended 31st March 25. The following information is available. Cash sales amounting to 50,400, of which 46,200 was in respect of standard rated sales and 4,200 was in respect of zero rated sales. All these figures are sold to all of these sales were made to the non-VAT registered customers. Sales invoices details are all given to you. Let's see the question requirement. Calculate the net VAT payable. All figures of VAT are exclusive of VAT. So let's calculate at one side output VAT and then I will calculate input VAT. Okay. This is output VAT. My bad. Sorry. And this is input VAT. Yes, all of you. Last question. Second last question actually. Okay, so output VAT first I will have on. So we have a cash sale which is given to you here. 50,400, of which 46,200 was in respect of standard rated sales. So of course on zero rated we don't have tax applicable. So we'll have it on standard rated sales. So here standard rated sales. So it will be, what is the output VAT? 46,200 multiplied by 20%. We are assuming all figures to be exclusive of VAT. Okay. Now sales invoices totaling 128,000 were issued in respect of credit sales to VAT registered customers. The sales have been all standard rated. Okay. And so we will have the standard rated sales for credit sales. Doesn't matter, we will apply the same standard rate only, and the standard rate is 20%. So 128,000 multiplied by 20%. Clear? Next one. On 20th February 25, a credit sale invoice of 7,400 was issued in respect of a standard rated supply to a VAT registered customer. To encourage this previously late paying customer to pay promptly, Gwen offered a 10% discount for payment within 14 days of the day of sales invoice. The customer paid within the 14 days period. Customer paid. Okay, and it is not given that what was the status of the invoice date. So we assume that the customer paid later on only. But Let's read it again, because we have to see whether I should multiply it with 90% or not. Let's check that. Credit sale invoicing 7400 was issued to encourage this previously late customer. Previously late paying customer. No, we will take the invoicing at full value and we will do a credit note. So we will include the input VAT here, right? Reverse the output VAT, sorry. So at the time of invoicing, we will do 7400 multiplied by 20% and multiplied by 100%. No, 90% will do. Now, why am I not taking 90%? Because it says previously late paying customer. So the history is that he is not paying on time. So invoicing is done at full value. Here I will reduce credit note. So I will take here 7400 multiplied by 20% multiplied by 10%. So yes, I will arrive at the same answering only even if I do 90%. But this is the correct way of doing it. So we'll do it in this way. Now next one. Standard rated materials amounted to 32,400, of which 600 were taken by Gwen for her personal use. So here material we will take for the standard rated, which is given here 32,400, and the standard rated will be 20%. Now 600 is taken by Gwen for her own personal use. So here we'll take full amount of material, because the one that has been taken for personal use, we need to reverse it. So here only we'll reduce it. Okay, so we'll take 32,400 multiplied by 20%. And I will reduce own use. So I will take here 600 multiplied by 20%. So I've reversed it. Done? Clear? Okay, let's go to the next one. Gwen sold machine for 3600. So machine is sold for 3600. Then we need to reduce the VAT. We need to claim output VAT on it. We need to charge output VAT on it, right? Because this is a sales made. And purchase new machinery at a cost of 21,600. So we'll claim input VAT credit on the same, the machinery which is purchased. She paid for the new machine on this date but did not take the delivery or receive an invoice until 6th April 25. So our basic tax point is then, see, we always take the basic tax point is the date of selling 28th March, because the delivery or invoicing is not done on 6th April. These figures are inclusive of VAT. So we will take them here only in this year. So I will charge output VAT on 3600. This is inclusive of VAT. So we'll take 20 by 120. Right? 20 by 120 we will take here. So this is sale of machine. 3600 multiplied by 20 by 120. Okay, now I will take here the purchase of machine. Okay, the purchase of machine, and I will take here the amount is 20. No, the amount is I missed out these two. I took machine. I'll take these two also. The amount is 21,600, correct? So I will take 21,600, my friends, and I will multiply it with 20 by 120. Done. Okay, so we are done for machines. Now let's take the ones that we have just left out in between wrongly. So now here I have standard rated material amounted, we have done. Standard rated expenses amounted to 2400, 800. You can claim input VAT on it. This includes 1200 for entertaining UK customers. So we have to reverse the entertaining of UK customers. So simply I can take here 24,800 less 1200. So 24,800 less 1200 multiplied by 20%, I can claim input VAT on expenses. right? We can claim input VAT on expenses. Now the next one is this car one. On 15th March 25, Gwen sold a car for 9,600 and purchased a new car at a cost of 16,800. Both cars were used for business and private mileage, but no fuel was provided. Now you know that if it's a normal car business, it will not be part of the VAT calculations only, because we will not take the input. Sorry, it will be a part of VAT calculation, but we have to do the calculations accordingly. Only when they are into the car running business or the car driving school, only then it will be part of the calculations. Here car is, it's not given that it is for the driving school or what purpose, hence we will not take any effect of car. However, since it is to be marked, therefore you will write car and you will write here 0. Clear? No input VAT, no output VAT, because that is only going to be done for the cars which is like Ola, Uber, the cars, Zoom cars or cars in driving school, that one. So we will not do anything for it. Now let's do the next one, impairment loss. On 31st March 25, Gwen wrote off impairment loss in respect of 3 invoices which were due for payment on 15th August 24, 15th September 24, 15th October 24 respectively. The amount of output VAT originally paid in respect of each invoice was 340. So we have to just reverse it. Now look here. The invoice which was due for payment on 15th August, add 6 months to it: September, October, November, December, January, February. And we are at 31st March. It is still unpaid, so of course we will consider it. 15 September 1, October, November, December, January, February, March. Again, I will consider because it is more than 6 months overdue. We are at 31st March and 6 months end at 15th March. Let's see the next one, 15th October. No need to check because it is going beyond 6 months. It is going within 6 months. See, because it is 15th of October. 6 months will end on November, December, January, February, March, April, and my year is already ending on 31st March. So that till that time, since the period is not over, so we will not take that input VAT credit. So here I will write input VAT credit on impairment loss. So I will take here 340, right? 340 multiplied by 2. There are 2 invoices that we are considering. 680 we will take. Okay, now let's go further. Almost the last point. Yeah, last point we are at. During the quarter ended 31st March, 600 was spent on mobile phone, of which 40% is private call. So business call is 60%. You will just take for business call only. So you will take 600 multiplied by 60% multiplied by 20%, which is the standard rate of VAT. Here, get the total of input VAT and match it against the output VAT. So net VAT payable will be net amount. 21340 is the net VAT payment. Done. Let's go to the next one. This is to understand the interest and penalties. Now, Penn was late in submitting a VAT returns and paying the related VAT liabilities as follows. Quarter ended, it is given to you. To ease of the calculations, I will just write the quarter ends. So here it is quarter ended 30th June 2024. Then it is 30th September 2024. Then it is 31st December 2024. And it is 31st March 2020. Okay, here I will write interest. I will calculate interest here. Here I will write penalty, which is fixed. And here I will write penalty, which is daily. Now interest amount, let's see, here you have, and here the penalty for late filing. So all things I will explain here by way of a tabular approach. Now for the quarter ended June 24, it is the first time the VAT return has paid late, so no penalty will be here. Interest is, it is days late are 10. So what is the amount of VAT due? 32,000 multiplied by 7.75% multiplied by 10 by 365. Okay. So 67.95 is my interest on it. That is approximately rounded off always. Now penalty fixed will be leviable up to 10 days. If it is there up to 15 days, there is no penalty. So no penalty will be here. Now it comes to next quarter. Again, it is the second time the return is late, so no penalty here. December, third time the return is late, no penalty. March is fourth time the return is late, so we will now have a penalty of 200. Okay, now let's come to interest. Here we have a delay of 50 days. Same calculation, you will do 36,000 multiplied by 7.75% multiplied by 50 by 365. Here again you will do like this, 41,000 multiplied by 7.75% multiplied by the delay is 18 days, 18 by 365. Here it is 29,000 multiplied by 7.75% multiplied by delays 8 days by 365. Done. Now let's go to the next one. Fixed penalty. The delay is 50 days. It is beyond 30 days, so the fixed penalty is 4%. 4% of what is the tax due? 36,000. So the fixed penalty is 4% of 36,000. Done. That is 1440. Yes. Now let's calculate daily penalty. Daily penalty will be there only when it goes beyond 30 days. So beyond 30 days, what is the number of days? 20 days. 50 minus 30 is 20. So here you will do the same way calculation. 36,000 multiplied by 4% multiplied by 20 by 365. Yes, here you will have days calculated. So this is your daily penalty. Now let's see the last one. Last one delays only 8 days. Since it is within the 15 days period, here we will have no penalty. Oh, I'm sorry. This has to be done here. Here you'll have no penalty. Now let's see this third quarter, 31st December. The delay is 18 days, so no daily penalty. Daily penalty arises only when there is a delay of more than 30 days. Here you have a delay of 18 days, only a fixed penalty of 2% will apply. What is the amount? 41,000 multiplied by 2%. Done. So this is how you will calculate your penalties and interest. I'm sure now with the 100% syllabus that we have covered for the revisions of your tax syllabus, it's all absolutely crystal clear. Guys, do share your feedbacks in the comment section. How was this revision session of 2 days? How did it prove to be helpful to you all? Please share the comment, like the video, subscribe to my channel, and make sure that you spread the word. Share this video so that more and more students can benefit from it. Thank you so much. All the best for your exams. Do well and just follow the channel for more such useful videos. Thank you.